Hi, I'm Sharon Winsmith, a tax attorney, active investor, and your go-to resource for proven investment and tax planning strategies. In this video, I'm going to talk to you about the ticking tax bomb that is coming from retirement plans. If you've been listening to the news lately or talking to, your friends who are getting close to retirement age, then you may have heard of what we're hearing called this ticking tax bomb. Basically, this happens from accumulating large balances in your retirement plans and having a situation where your required minimum distributions are creating a huge tax headache for you in the future. So I'm going to explain to you what the typical fact pattern where you have this ticking tax bomb is and how it arises. I'm going to walk you through a quick model so that you could see how required minimum distributions are calculated and how that can add a lot of money to your taxable income if you do have balances of a couple million in your retirement plans. And then I'm also going to show you at the back end what to do to fix the problem. So I'm going to talk to you about backdoor Roth IRA conversions, why you might have heard that so many people are doing these right now and why they're so popular. And then I'll just briefly cover how you do a backdoor Roth IRA conversion in practice. So to start with, I want to explain the basic fact pattern of where this ticking tax bomb arises. This really applies to wealthy individuals, people who have accumulated a lot of wealth over time, or if you're someone who's younger and you're, a high income earner and you're maxing out contributions to your retirement plans, then this is a good video for you to listen to because you might be able to prevent the ticking tax bomb by learning from people who made this mistake in the past. So the reason this arises is because CPAs, financial advisors, everybody was telling you max out contributions to your 401ks or IRAs. This applies to a situation where we're dealing with retirement plans where contributions are on a pre-tax basis. So you put money in because you thought, let me defer the tax bill in this to a time when I retire and make less money and I'll be in a lower tax bracket. So the issue is that you've got all this money inside a 401k. The same applies for IRAs. I'll just use 401k, to simplify, but it applies to any traditional IRA that's not a Roth. But the situation happens that you've got millions of dollars in this 401k because of compounding growth over time and the contributions you were doing. And you're having a situation where you're going to turn 72 or 73, whenever the required minimum distributions kick in for you. And you've got to start taking money out of that account. But you are a very savvy and disciplined investor and saver, and you built up a large net worth outside of that retirement plan. Maybe you've got investments in the stock market that are paying you dividends, real estate funds, other types of investments that are funding your living expenses, and you don't need those distributions. So I used to work solely with wealthy, high net worth individuals. None of them ever needed these distributions from their retirement plans. They always delayed them until they were, required to start taking those RMDs, which is now 73 if you aren't already, 72 years old before the end of, 2022. So for those of us that are, below the age of 73 now, we are going to have to start taking money out of our retirement plans when we hit 73, whether we need it or not. And if you're listening to this video, you're a savvy investor, you should not need that money and you don't want that money. And why do you not want that money in those distributions? Is because it's taxed at the least efficient way possible. So you're paying, the highest tax rates, it's ordinary income. There's absolutely no tax planning that you can do at that age. There could be some tax planning when you're in your 70s and older. You do not want to be, out there running businesses or, investing in real estate yourself, going out and buying properties yourself and managing those. You're not going to want to do the strategies that might be available to you, if you put in the work and time to minimize the tax bill on that. So you're basically, increasing your ordinary income by hundreds of thousands of dollars every year. This is kicking you into the highest tax bracket or a higher tax bracket in a lot of cases. And you're paying more tax than you probably would have if you had not, made those contributions in the first place. So I personally think the CPA industry and to a large extent, the financial advisors out there really have a lot to answer for this. This is a complete disaster for wealthy individuals. We weren't expecting, the issue from just, having these RMDs kick us into the highest tax bracket. And we weren't expecting, because we weren't advised properly on real growth rates that were going to happen. Financial advisors always undercut the growth rate that your account's going to have. They'll say 6% when it's really should be 10%, or higher. So you've got, because of compounding investment earnings and maxing out your contributions because you were listening to your CPA, you've got a situation where you got several $1 million in this retirement plan. You don't need the money because you saved otherwise outside of those plans. You don't want the money because it's taxed at the highest rate. So you're sitting here stuck with, what do I do? So the answer is that you do a backdoor Roth IRA conversion while you still can. And I'll talk to you about that in just a minute. But to start with, I do want to just show you how the RMDs are calculated. So RMDs are required minimum distribution. So once I'm going to say 73, if you're someone who was already 72 before 2022, then you're already taking these out. So I'm going to assume, 73, we've got to start taking these. They're required distributions that you have to take from your account. So even if I don't need money from my 401k or IRA, I've got to take that money out because they don't want it sitting there tax deferred forever. They want to get their tax money, right? The IRS wants to get their taxes on that money and they don't want you delaying it, indefinitely. You might hear, we joke a lot about RMDs really stands for retirement, money drainer or ready for major disappointment because they're just a disaster to work with. And I'm going to show you why. So RMDs are calculated as a factor of your life expectancy. So the IRS issues, life expectancy factors. They have a table where they tell you at 73, this is the life expectancy factor. And you take your year-end account, whatever the account balance in that 401k or IRA is, divide it by the life expectancy factor, and that is your required minimum distribution for that year. So what people forget to take into account is that this money is still growing. I might have to take out $132,000, but everything else in that account is still growing. So it's going to be even higher and higher as when I hit later years in life, that RMD is going to, increase because the account balance is going to continue to increase. So I've assumed an average return of 10%. That may not be what you're earning. You may be working with an advisor who tells you to put it in bonds or something, so you're probably not getting a very good return there. I'm just using 10% because I think we have to illustrate this in a way that really, reflects reality. And in my experience, savvy investors who know what they're doing and take control of their finances themselves should be able to get 10% returns on average every year or something close to that. And you have to use an accurate result. I've seen financial advisors, model retirement accounts getting 4% a year. I don't understand that. If you are only getting 4%, that would be very scary to me because that's not even keeping up with inflation right now. And I don't know what you're investing in that you're only getting 4%. So it is important that you use an accurate return so that you can really see how bad this is going to be. If you've only got 3.5 million and you may think that sounds like a lot, that is not a lot of money. If you're someone who started making maxing out contributions early in life, or started doing catch-up contributions when you were able, or had an employer match and were taking full advantage of that, or, I'm assuming you invested this wisely in something that was getting you 8, 9, 10% returns every year. So if you think this is unreasonable, that this is not an uncommon fact pattern. I know a lot of us would feel, yes, we'd be very lucky to have this much money in our retirement accounts, but this is a very common fact pattern for a lot of people in this country based on where things sit right now. So if you're 3.5 million, which is, a respectable balance in your retirement plan, this is the type of, this is ordinary income going to increase the income that you're getting, otherwise on your tax return from Social Security, other investments, dividends, interest, whatever you're investing in and returns you're getting on that. This is going to increase that. It's going to be taxed and increase your taxable income at that. It's taxed at the highest rates. So I just want to show you, I want to go all the way out to let's just go all the way out to 95. So, our account balance has increased at 10% on average every year. So even though we're taking out these required minimum distributions, I've got over 7.7 million in my account because of that compounding. And, we have to also take realistic life expectancies into account. If you're a healthy individual and you take care of yourself and you've got the resources to have access to good medical care, the thought that you're living to 90 and over is not that unreasonable, right? So I think you really have to think about it that way. And the problem is now I'm paying, $800,000 plus on these. I've got these RMDs of that. And this all came from an account that was 3.5 million when I was 73 years old and required to start taking these RMDs. So again, this may sound crazy to you where you sit today. If you're, in your 20s or 30s and you're a doctor or a lawyer and you're maxing out your contributions, if you think you can't easily end up in this position if you keep doing that, you're wrong. This happens all the time. I can't tell you the number of people that have come to me with these balances in their accounts. And now it's like there's nothing we can do. You're just going to pay the highest tax rate. And also now let's say you die when you're 95. You've got $7.7 million that is really inefficiently going to be passed down to your heirs. So they've got to start taking it out within 10 years, usually in most cases. And guess what? They're going to be in the highest tax bracket when they do that. So you're pushing down a really bad tax problem. So maybe it's not, it's your ticking tax bomb, and then now it's your heirs ticking tax bomb. So it's a disaster all around from not only your income tax planning perspective, but also an estate tax perspective, because there's very little that you can efficiently do to get this outside of your estate and avoid estate tax. And there's also, basically very little you can do to prevent your heirs from having to take all this money out in 10 years and pay the highest tax rates on it. So it's just not great. I just want to show you again, $5 million in your account. You're looking again at, almost 200,000 just in year one when you have to start taking these RMDs of ordinary income that you have to pick up. Again, here's $8,300,000. You're going to be in the top tax bracket probably at that point. If you've got that level of money, there's no way, that you're not having other investments that are kicking off a lot of income. Your Social Security is going to be, another point you have to take into account. Again, you may think these balances are crazy. Model it out. I model it out wherever age, you started making those contributions, model out a 10% or, 9%, 8% average return on those balances every year. Assume that it's growing at that amount. Assume you're putting in the maximum contributions amounts every year, and see how this can easily get to those numbers. This is not outrageous. And again, keep in mind that 8 million today is a very different number than 8 million when someone that's in their 30s is 73 years old, right? So when our grandparents were retiring, them having a million or two was a great, that they were very well off, right? That was probably like, upper middle class to lower upper class. Now, when we look at when we're going to retire and, when inflation kicks in and that type of thing, that is going to be the 3.5 million retirement account. So you have to think about these things in reality and what they're going to look like, model it out, because look at this. Let's say, this is where we end up, which I think you could easily do if you're a high income earner. Let's look what happens when we're 95. Guess what? I've got almost an $18 million 401k or IRA. Yes, my heirs are happy to take that money and take those distributions, but they're going to pay astronomical tax rates on that. We don't even know what tax rates are going to be then, but we know they're going to be higher than they are now. And you're picking up $2 million a year taxable income. You don't need that money. You're going to, pay probably almost 50% tax rates on that when you factor in state and local, and higher sometimes if you live in like New York City or California. So this is a disaster. This is the ticking tax bomb. Do not let yourself think this is not a reality. Yes, if you're 73 years old and you're watching this video and you don't have this much money in your account, then, this probably isn't relevant to you. But if you're my age and, I don't contribute to 401ks and IRAs unless I were doing using that year to do a backdoor Roth IRA conversion strategy, but I don't do that anymore. But if I did, I would model this out, and I could easily see myself how I could get in this situation where it's just a complete disaster waiting to happen. So now we know we've got this problem. What do we do about it? So I want to show you just quickly how to do a backdoor Roth IRA conversion. So this is, you may hear a lot of people are doing these. They're extremely popular. I think these are probably as popular now as they've ever been in my career because of this problem. If you have a wealthy friend that's older than you and, you can talk to them about how they're investing their money, you may see that they're probably doing this now that we realize it's kind of a disaster. So why do we want to consider doing a backdoor Roth IRA conversion? I'm not going to tell you to do it. You need to figure out yourself if that makes sense for you. But why might we want to do this? It's because we lock in the current tax rates. We know tax rates right now are lower than they will be in a couple years because the rate decreases with the Trump tax law changes sunset in a few years. So we know all else equal, we're going to be paying a higher tax rate because rates are going up. Again, I'm not going to bet on what rates will be when I'm 72 or 73, but I would not bet that they're going to be lower. I just think with the way this country is going, there's absolutely no way that tax rates will be lower than they are now. Tax rates are the lowest they have been in modern history. So it's important that, we want to think about locking those rates in now. Yes, you're going to pay tax when you do that backdoor Roth IRA conversion. Yes, it's going to be a lot to stomach to pay that tax bill. But if you really understand what you're doing, you're just going to rip the Band-Aid off and do it, right? So I think it's definitely something you want to talk to your CPA about and consider it. Backdoor Roth IRA conversions, we like them because they comply with the pay tax on the C, but not the harvest strategy that I've talked a lot about with modern tax planning. We'd rather pay tax on money now, invest it in a way that we never pay tax again, which is what's great about Roth IRAs. They're, after tax. So yes, you've paid tax on the money that went in there, but you don't pay another dime again, ever in the future, and you don't have RMDs. So you can, avoid RMDs because Roth IRAs, you're not going to need that money, right? You're independently wealthy outside of your retirement account. You don't need the money in those plans. You can get it inside a Roth. Everything grows tax-free. There's great estate planning ways to pass that money down to your heirs in a way that they don't have to, pay a bunch of tax that I talked about with traditional 401ks and IRAs. Also, you avoid making your other income subject to the highest tax rate. So those RMDs are going to increase the bracket you're in. So your Social Security income, your other investment earnings, your, any other type of income you get is now subject to that higher tax rate because of those RMDs. So this avoids you having to do that because you don't have to take those required minimum distributions and you're not increasing your taxable income by those RMDs. As I mentioned, you can efficiently pass money down to heirs this way. And also this allows you to take advantage of tax strategies while you're young and still working. I can do tax planning now today that can minimize the tax bill that I'm going to have to pay on these backdoor Roth IRA conversions. Maybe I become a real estate investor, do the short-term rental loophole, take advantage of bonus depreciation still being on the table. If I'm a business owner, there's endless tax strategies available to you. You absolutely, with the qualified business income, 20% deduction. There's, all kinds of deductions available to you. That means you're going to pay a much lower effective tax rate today on this money than you would in the future when you're not working. So you can do tax planning today that you're not going to want to spend the time, effort, money. You just don't, when you're 70 years old and older, you're not going to want to be doing much, right? So, or certainly not, things like running businesses and getting involved in the day-to-day of that. For most of us, I probably will still be doing that, but you get the point. You can do tax planning when you're younger. It's much easier to use those strategies that are available today than in the future when you're much older. So let's say you decide to do a backdoor Roth IRA conversion. It's very easy. I have other videos where I've talked about this, but I just want to run through what you're going to do is just set up a new Roth IRA account. You can do that as self-directed. I personally prefer that. I don't like to pay fees for this kind of thing. Just set up a new Roth IRA account. You want to make that distribution from your 401k or IRA directly to that new Roth account. You don't, you got to comply with the rules to make sure you don't get hit with that 10% penalty. If you do this right, you shouldn't have to pay the penalty. You should only have to pay the tax on the taxable income from the money that you roll over. Once you do that, lots of times you can just transfer the money directly online. You might have to get a check, but make sure you immediately put that check into your Roth IRA and deposit in there, because if you hold it too long, then you could have, a situation where the penalty applies. So get that money in there, make the distribution straight from old retirement account to new one. You can close out that 401k or IRA if you're not going to use it again. And then just remember to pay the estimated tax due on the rollover. You are going to have taxable income in the full amount that you roll over. You cannot use money inside that account to pay the tax. So you have to have the cash on hand or access to cash outside of what's in that account to pay the tax bill, which will be huge. Yes. And, don't forget, if you want to make estimated tax payments on that to avoid, any estimated tax penalties, make sure you do that. But just keep in mind, yes, you are going to have a huge tax bill the year you do this. Maybe you want to do a little bit over time to make it a little bit more able to stomach the big tax bill. Maybe you can do some tax planning with real estate or businesses to lower the effective tax rate on that. But just keep in mind, you are going to have to pay tax on the money you roll over, and you can't use money in that account to pay that tax bill. So again, this is just, something to consider. Don't just assume that this is not applicable to you. It very well could be if you're a very disciplined and savvy saver and investor. It's a fact pattern that I think our generation is hopefully going to learn from our parents and the ticking tax bomb that they're all facing right now and dealing with, that we won't have this same problem because we will consider handling this sooner and avoiding the mistake that we saw our parents make. So hopefully you found this video helpful. If you did, please like the video and subscribe to the channel.